China is going to export inflation on purpose and blow up the US bond market as TLT and the Fed crash the stock market. Why did both stocks and bonds just start falling right now? Yes, it's going to get worse. Stocks tend to fall further when EPS growth turns negative. Right now, S&P 500 forward EPS growth just turned negative. This explains why. Not only NASDAQ are selling off, because TLT is dragging it down, but Dow Jones are also sold off 2% too. A week ago, YouTubers like Jeremy and gurus like Jim Cramer told everyone to buy, as they thought the economy is going back to normal, or a new bull market has just started. As Powell keeps repeating, disinflation, that almost feels like a fantasy now. But during last week, when extreme greed hit 80, most people can't contain their emotions to buy. As they saw stocks like Palantir go up 20+% in a day, they completely forgot how we got here. Economic war is not over. Why China is going to export inflation on purpose and blow up the US bond market as TLT and the Fed crash the stock market. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? The two biggest buyers of treasuries, China and the Fed, are done. The implications are higher interest rates and scarce cash, which could put pressure on long-duration assets like unprofitable tech stocks. The same stocks that have soared so far in 2023. On top of that, fiscal stimulus from the US government has ended, and it's unlikely there are any more going forward because of gridlock in Congress, meaning they are using the debt ceiling to force spending discipline. Corporations are tightening their belts and have embarked on a wave of layoffs. Insiders are selling their shares rapidly because they know this economic war is not over. China is exporting inflation to the US as we speak. The Fed don't have the power to fight the market. Russia and China's inflation at the same time. So they have to be more hawkish. The Federal Reserve could lift interest rates 3 times this year to fight inflation, according to Goldman Sachs chief economist, and that could turn up the pressure on stocks. He expects the Fed to raise rates by 25 basis points at its March, May, and June meetings. The U.S. Central Bank may be worried the economy is on the verge of growing too hot again. The recent numbers have been stronger than expected on the growth side. Plus, we've seen some higher inflation numbers for January. It reinforces the idea that the Fed still has work to do. So we think another 75 basis points from here, with no cuts until 2024, seemed like a more likely outcome. The U.S. inflation rate rose 6.4% on the annualized basis in January, while price pressures have been moderating since mid-2022. The reading showed inflation still remains far above the Fed's 2% target. Inflation has stayed stubbornly high despite the Fed's historically fast pace of hikes. It has taken rates from almost zero to nearly 5% within the past year. And it has signaled it expects to lift them even higher in the coming months. This marks a stark contrast to what markets expect of the Fed moving forward. Most investors anticipate the U.S. Central Bank will ease up on tight monetary policy, or even start cutting interest rates this year as inflation cools. But with retail sales and payrolls surging and unemployment falling, there's a possibility the Fed may decide it has to keep ratcheting up interest rates. Higher interest rates encourage saving over spending and make borrowing more expensive, which tends to alleviate upward pressure on prices. However, they can also sap demand, slowing economic growth and dragging down stocks and other assets. Why inflation is still too hot, even though headline CPI number has came down slowly. A large number of economic thinkers that I expect are calling for peak inflation, and that interest rates increases have topped out. With oil prices down from $120 a barrel to $76 today, this would be a strong indication of reduced inflation pressure. Peak inflationists even have the benefit of financial markets agreeing with them. With U.S. 2/10-year yield curve as inverted as it gets, inversion really is the market's way of saying that they don't believe central banks will raise interest rates any further. I do not see central banks, and particularly the Fed, going dovish until they get food inflation under control. So let us look at the most recent U.S. CPI data from a food inflation perspective. On a year-over-year basis, it is still rising at 10%. And even though it is slowing a little, it's still doing 10% on high comps from a year ago. What I really like about food inflation is that it is universal and easily understandable. A Birkin bag or a Panera costing 30% more is not inflation that matters to most people, but the price of bread and meat. That matters to everyone. White bread CPI is still rising at nearly 20% year on year, while meat CPI is back to 2%. For CPI calculations, food CPI is given a total weight of 13.5%, with bread having a weight of 0.2% and meat having 1% weight. This means that soaring bread prices should not be that important to Federal Reserve. But soaring bread prices are very important to politicians. Certainly more than the CPI weightings given above. For me, the question comes down to whether the meat index is right. or the bread index is right. In other words, will bread prices fall back or will meat prices spike? One of the best things about free market capitalism is that incentives are transparent. For U.S. pork farmers are currently disincentivized to farm pigs. The price of hogs relative to corn are at close to 40-year lows, meaning that hog prices are not covering the cost of feed, which is mainly corn. With hog farmers disincentivized to farm hogs, then one of two things must happen. Corn prices must fall, or hog prices will rise. When we look at the corn market, we see that China has become a major buyer of U.S. corn. This, and despite of the Chinese placing tariffs on corn imports, that have meant that Chinese corn prices are much higher than U.S. prices. In other words, geopolitics has driven China to have high food prices, which is now exporting back to the rest of the world. With Chinese activity picking up, my guess is that corn prices globally will remain high, which means feed prices will stay high and meat inflation will catch up to bread inflation. In my view, food inflation is still ongoing, and hence central banks will keep raising rates. In the meantime, Russia's oil sales to China have hit their highest level since the start of its war with Ukraine last year. The commodities analytics firm found that Russian crude and fuel oil flows to China rose to 1.66 million barrels a day last month, up from 1.2 million December. Meanwhile, China has been snapping up discounted Russian crude as the West shuns Russia. Russia's oil and gas revenue crashed nearly 50% at the start of 2023, a sign that Western efforts to crimp Moscow's war revenue were taking effect. Russia has also made efforts to intertwine its economy with Beijing and take its partnership to a new level. That includes measures like increasing its dependence on the Chinese yuan and plans to create a new reserve currency between the two nations that could rival the US dollar. Also, China considering providing lethal support to aid Russian invasion of Ukraine. As the attempted Russian takeover of Ukraine nears its one-year mark, Secretary of State Antony Blinken said, China is actively considering providing lethal support, including weapons and ammunition to aid Moscow in its war against Ukraine. We have seen them provide non-lethal support to Russia for use in Ukraine. The concern that we have now is based on information we have that they're considering providing lethal support. And we've made it very clear to them that that would cause a serious problem for us and in our relationship. Now that Russia and China are making an alliance against US together economically, how do you expect the economy going back to normal or the stock market going back to a bull market again? As China injects the biggest cash injection, pushing up the commodity prices, look at the price of Dr. Copper going back up to an all-time high again. The price action of TLT suggests inflation's story is not over. The real painful stock market crash is yet to come. And this is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an awesome book. Order your copy today. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.